Welcome to the XY Advisor podcast, where it's our goal to help you become the best financial advisor possible and drive the positive evolution of financial advice. Hub24 is an ASX-listed company with over $15 billion funds under management and one of the fastest growing platforms in the market. Neither a bank nor part of a bank, Hub24 focuses entirely on connecting advisors to a broad range of investment solutions for their clients. Discover why other advisors think Hub24 are the best in the market and access the benefits of choice and efficiency for you and your clients with their market-leading managed portfolio solution. To find out more, visit hub24.com.au. G'day, how's it going? What do you know, Striker Light? Clayton here from XY Advisor. Just chatting with Steve today in the glorious, as you just mentioned, most professional podcast studio you've ever been a part of.
Is.
Going to claim that. Obviously, Fraser Jack would disagree. All right, ETF Watch. The thing that I found really interesting about our conversation that we had via the XY platform was a lot of people talk about they understand investments, but then very few people actually build a fully resourced website to show the world how much they know. And I dug it, man. So ETF Watch, when did it start? Why did it start? Talk to me about it.
Yeah, so started it in end of 2015.
Okay.
So about 4 years ago. And it just sort of started, at the time, ETFs was starting to really get popular.
Yeah.
They're starting to sort of hit the mainstream a little bit more. But the information out there in Australia about what was available was just pretty limited. And literally, it was probably early 2015 where I was like, it's time to sort of understand a bit more about ETFs. And I went to try to find a list of ETFs out there, and it was literally going to the ASX website and downloading a PDF.
Yes, that's right. Yeah.
And you can't do much with a PDF. And once that volume of ETFs got to a point where there was quite a few out there, and you want to go search for certain specialities and that sort of thing, it was really hard to do that. And saw in the US and UK, where the markets were more mature, there were a lot of sites doing this. And so I thought, well, there's an opportunity here to kind of be the Australian ETF site. And so launched the site with a sort of fund screener, which allows you to go and sort of filter and find funds that meet your needs. And then launched a blog and mailing list with it. And it's just kind of gone from there and sort of grown every year. And
it's pretty cool. Are you the one doing the research, or do you have other people doing the research?
Look, I wouldn't call us a research site. We're not trying to compete with a research house.
Yes.
So we're more just providing
research like blogs. Are you?
Yeah. So I'm writing the content pretty much. Get the odd guest poster. But yeah, I'm kind of keeping up with what's going on, new funds being listed or new trends emerging. And just keep the content going on that. You try to write a couple of blogs a month.
Yes.
And there's always new funds being listed and stuff, so there's plenty to write about.
So you've got obviously iShares that are owned by BlackRock and Vanguard, who are pretty much the biggest two players in the market.
Yeah.
Are they constantly launching new ETFs, or is it smaller players that are entering the market?
They are. They're probably beta shares over the last few years has been the most prominent. ETF. They've launched a lot of ETFs. They've got over 50 now, I think.
How good's the strong bear one where it doubles?
Yeah,
it's,
not real good over the last year or so.
Exactly. But I always thought, and tell me if I'm wrong, so you might understand. So when volatility goes up, the VIX index goes up, obviously, and then the price of a put option goes up. So it's expensive to make money from the idea that the market's going to go down. But I feel like with that strong bear, rather than going out and betting against the market, you could always purchase this strong bear and get double whatever, it's a really simple algorithm.
Yeah.
But I always think to myself, rather than get way too deep into it and be purchasing options, if you think the market's going to go down, and just go on to CommSec or whatever, purchase your strong bear, and then hold it for as long as you want, and you're not paying for any of the increased volatility.
Yeah, and that's one of the advantages of ETFs, right? There's like all these different sectors and different themes and trends you can invest in.
Yeah.
Through just a share trade, and like you say, you can do that without the leverage and the risk of options or CFDs or any of those sorts of things. Obviously you're still carrying a lot of risk by doubling down on markets falling. But yeah, without and all that complexity that comes with those sort of other instruments. Yeah,
totally. I always try to find an easy way to do something. I remember finding out about really getting into shares when I was a tax accountant, sort of like the mid 2000s, so just before the GFC. And it's kind of interesting. What I used to do was I figured out that the specky stocks, right, they would move on news in the market. So rather than, I was certainly no technical analysis investor. I wasn't even fundamental. I was, what's the news and can I front run the news? Which, is actually how the bots trade most of the market these days, to be fair. But so back in the day, there was this little specky sheet and I subscribed to it. But then I noticed that as soon as the specky sheet was sent out to the mailing list, right, that these little shares would go up 100, 200, 300, 400, 500% in the space of a couple of minutes.
Yeah, right.
And I also noticed that the URL where each monthly specky sheet, the PDF, good old PDFs, was hosted, right? So you'd have to wait on the email. Whoever got to the email first would then click on the link to go to the PDF. And the PDF was hosted on a very predictable URL. So what I did was I was like, okay, cool. So I can tell what the URL for next month is going to be. And so I would stick a like an alert function on this URL that didn't exist.
Yeah.
And it would tell me as the moment that the PDF was uploaded. And it was uploaded like, a half an hour before the email was sent out. So I would get this alert and be like, boom, there's the research. Go in and purchase, $1,000, right? Like I didn't have much money. And I would purchase $1,000 and then the rest of the share would come on. It would spike a couple of 100% and I'd sell. And I thought I was a genius. I was like, I'm definitely the smartest guy that's ever existed and I'll never have to work again. But then like 2 months in, the guy goes, yeah. So we figured out that someone's like reading the report before it goes out. So we're going to have to, make the URL variable. And I was never able to do it again.
That's the problem with those schemes. They always work until they don't, right?
Oh, 100%. Yeah. And I learnt my lesson there. So funnily enough, they actually put up a pretend one.
Really?
Yeah. So they got me. So I ended up purchasing a bunch of shares and I lost pretty much all the money that I'd made. They were kind of cheeky, but I was being cheeky. So it all worked out fair in the end. So love a good share trade. Got into ETFs after that because I was like, I'm way too emotionally attached to shares. And I never purchased another share after that little jaunt. ETFs, on the other hand, do a lot of the work for you. And there's passive and there's active. What do you tend to think in terms of, into your mind, are there any active trading algorithms that you're impressed even exist in an ETF?
Most of the active ones are it's still the human, like a traditional managed fund where you got a fund manager who's trying to use their skills to outperform. And they might have their own tools to do that, to do some quant stuff in the background, but they're kind of not giving that IP away. Some of the more interesting ones is that middle ground, which the industry calls smart beta, which is the not active and not passive, but kind of in the middle where they're still rules-based, but they're still rules-based like a passive ETF, or as passive ETFs just following the market cap weighted index.
Yes.
But the indexes that the smart beta follow has been developed using some sort of other methodology. And there's some quite interesting ones there that show that there are ways that, to outperform the market by just using an alternate methodology.
Do you seriously think that you can outperform the market using a simple methodology?
Yeah, well, like a simple one like equal weighting your allocation. So a standard market cap index, if you invest in the ASX 200, you've got 10% of your portfolios in CBA. I think they're the biggest at the moment.
Yeah.
Whereas, by equal weighting, you're not getting that kind of exposure to just a few companies. You're equal weighting across the whole market.
Yeah.
And it's proven over long time periods to provide better performance.
And it makes sense. I mean, if you're investing 1% of your, okay, let's not call it 1% of the wealth, but 1% of the allocation to, say, Australian, equities, and 1% of that allocation is in number 200 sized company in Australia, like that's still a pretty good investment, but you've got a huge uptick for growth potential.
Yeah, that's right.
Yeah. And so totally that makes sense. Because passive was, the term passive was just given to market weighted top 200, but it's technically that's no more passive than...
No, it's still active, right?
Yeah, exactly. Exactly. That's really interesting. Yeah. I remember someone explaining it to me once. I was like, it is. God, that was great marketing to call that passive.
Yeah.
But equal weighted for that same exposure rather than market weighted would be technically as passive.
Yeah.
Like, there's no reason why it's not.
It's just that the market weight indexes are the indexes that everyone kind of follows. So that's kind of deemed to be what's passive.
Okay, so it basically just reflects the ups and downs of the market, probably just with more intensity, more volatility. So it's up further when it's up and down further when it's down. But I guess technically, if we expect the market to go up over the long term, then, well, you're going to end up ahead.
Yeah. Yeah, and you're getting like you say, you're getting 1% in the 200th largest company, which probably has more growth potential than the largest company, right?
Yeah.
So you're getting more access to the companies coming up the ranks. Yeah,
that's cool, man. So how much time do you have to put into running this website?
Not a lot.
It looks cool. Did you design it? Are you like a hacker?
I've done a bit of UX.
Yeah, looks good.
So I can kind of hack together a screen design, but I can't code.
Okay.
So I've done that and then sort of handed off to some developers to develop the site.
So what do you design it in, like Photoshop or something like that?
Yeah, there's there's other tools that allow you to do sort of simple kind of design work.
Cool.
So I've done a bit of that through my career. So that's not too that comes kind of naturally to me.
Yeah.
But it's not my full-time kind of job. So it's only a bit of a side hustle.
Yeah.
Which is why you only see a couple of blog posts a month, because it's, it takes a lot of time to write content.
Oh man, so long.
And so I kind of, spend as much time as I can. It's probably a few hours a week on it. But it's definitely not a full-time gig for me. That's for sure.
Yeah. No, it makes sense. Well, I mean, XY was a hobby side gig for 6 years until it wasn't. So there you go.
Yeah, that's right.
Now, for the listeners out there, you were a paraplanner for a while and you became an advisor for like 6 months.
Yeah, very brief period. I started as a grad with CBA in their financial planning division, and sort of spent that next 15 years basically in that financial advice space, but not as an advisor. I did, at the end of the grad program, I did a very short stint as an advisor, and then decided that wasn't really for me, and then got more into the, started in the paraplanning and eventually ran a paraplanning team, and then moved more into the kind of licensee services kind of space. A lot of project work, rolling out FOFA and a lot of sort of growth innovation sort of work.
What does growth innovation work mean?
Oh, trying to spend a lot of the last few years at BT actually working as a product manager there for the advice business. So trying to, provide a better client outcomes, more like digitizing processes, just try to provide a better client experience and advisor experience throughout what is tends to be a pretty clunky kind of process.
Insanely clunky. Yeah.
So that was a challenge, especially in a large corporate. You got a lot of technology issues, like huge. If you want to change a field in one of your applications, it's like hundreds of thousands of dollars. It's
Jesus.
so like I think there's smaller end of towns definitely probably got an advantage there because it is difficult to innovate in those large organizations, that's for sure.
Yeah, I think it's because obviously they're designed to earn revenue, and they're very well designed to earn revenue. And so from their point of view, especially these huge product manufacturers, Big Four, their goal is to make billions of dollars. And so ultimately, they've got to compete with their commercial outcomes with the government's regulatory outcomes. And that's a very difficult job to do. And companies that I guess don't have such difficult waters to navigate can handle those changes a lot easier. And for many, many, many years, the Big Four were able to do quite well out of it. But now, BT, for example, and a few of the other products, they're escaping advice at this stage.
Yeah, because it's just got, like you say, like a big company to comply with the legislation and having ASIC keeping a really close eye on them. It's just got too expensive to do business for them. Yeah. And it's just where in the early 2000s they all got into vertical integration and went, this is a great way to make money. As that regulation hit, that really was designed to break up vertical integration, it all got too hard, I think.
Yeah. It's super interesting in terms of watching. I mean, if anyone could make financial services a profitable, massive scale company, it was the Big Four banks, and they couldn't.
Yeah.
And then you've got, the most successful one of the handful of the most successful entrepreneurs in financial services in this company, Boris, with Yellow Brick Road, wasn't able to do it.
Yeah.
And whenever I look at anyone who's trying to do something massively scalable, that no one is able to do it. But if you look at companies that just sort of focus on delivering a great outcome for advisors and don't try and twist their arm into anything. I mean, the biggest growing, say, platforms of the market, your Hub24 is in NetWealth, right?
Yeah.
Oh, there's BT Panorama, but in a lot of ways, that's just because inflows from the old BT product. Yeah. But scoping that out, you got NetWealth and Hub24, and they're not aligned to any dealer group, and they're doing really well in this new market. So it tells me definitely stay in your lane, offer and don't blur the lines between product and advice. And the moment that you separate product and advice has a chance to flourish. ASIC gets out of the way. And there's this whole, I guess, issue in financial planning, which has been the result of, profit at huge scales, kind of creating a lower quality outcome for both the advisor and the client. And there's this really sort of weird interrelationship between product and advice, but that is finally, I can see, getting ripped apart. And unfortunately, advisors are now the ones that have to suffer the consequences of all of that. But hopefully at the end of it, we're actually going to see what I see as the most valuable profession around, which is financial planning, finally being able to excel. So maybe I'm being optimistic.
No, I agree. I think it's still a long time away, particularly because it's going to take a real change at the government and the regulator to see these green shoots and then relax what they're expecting, because they're always looking for the 1% of people doing the wrong thing, and whilst ever that 1% is still around, it's very difficult for them to unwind the legislations that have been put in place. So it's definitely on the path, but I still think it's going to take a long time. But I think anyone who hangs in there, hopefully, will start seeing, eventually an environment that's simpler to operate in.
Yeah, I think the more I look at what ASIC have been doing, I actually tend to think that they've got I think they do understand that advisors aren't the problem. It's just that the advisors have operated in a problematic environment. And I'm as you just said, I'm really excited to see the regulatory environment start seeing better outcomes for clients and less conflicts moving forward, and hopefully at some stage relax a little.
Yeah.
As a part of that, though, occasionally things get through the cracks, such as the commissions paid on IPOs or LSEs.
Yeah, it's been an interesting one lately.
What? I didn't even know that existed. What's up with that?
Yeah, so as part of ETF Watch, we also cover listed investment companies. And the reason why when I launched ETF Watch was I was like, is this ETFs only or is this ETFs and LICs? And the reason why I kept it as both was because there's more and more active ETFs that are essentially investing the exact same way as the LICs. Some of them are even the exact same strategy offered as a LIC and an ETF, and it's really just the tax structure that's different. And so it's like, well, if you're a self-directed investor looking at investing in a fund that you can trade on the ASX, well, you should open your mind to ETFs and LICs. So I included LICs, and the history there is obviously as part of FOFA, commissions were banned on managed funds. But there was an exemption granted to companies raising capital in IPOs. And the argument at the time was, companies raising capital in IPOs it's an essential part of a thriving economy.
Yes.
And, if you're not an investing company, but a trading company and you need to raise money in an IPO, well, that money goes back into the economy and it's ultimately a good thing for the economy as a whole. But listing investment companies were included in that. And
that's a weird one.
And it means that...
that's a big difference.
Yeah. It means that essentially a fund manager can go and round up a bunch of brokers and come up with a investment that they want to raise capital for, and the brokers can then go and... brokers are then remunerated by how much money they raise, and the commissions are usually around the 1% to 3%.
That's insane.
Yeah. And what we've seen is probably since 2014 a booming LIC IPO environment.
Wonder
that
why.
Probably came to a head like in 2018. I think there were about 15 LIC IPOs, and there were these fund managers that were very unknown. They had like small little funds, and then they went and did a LIC IPO and raised $1 billion. And then they got in at that time where like they just had 2 years of good performance, so the brokers could be going, oh, well, these guys have done 20% for the last 2 years straight, and that's where we're at now. And it's last year, late last year, it sort of got on ASIC's radar, and there was a few media commentators that started going, hey, this isn't really right.
Good on them.
Yeah.
Do you know who they were? Shout out to them.
Chris Joy,
Well
with
done.
AFR, like he's a fund manager and an AFR commentator. He's been very vocal about it.
Yeah.
And it's just come to a head now where Josh Frydenberg just announced a 4-week consultation into it.
Yes.
And so we'll expect probably, I don't know if it'll be a budget thing that they'll launch in the budget, or at least probably before the next financial year, there'll be some new rules around it. But it's a really important one for financial advisors because, financial advisors have been the whipping boys of poor conduct for a long time now.
Absolutely.
And a lot of the media is saying financial advisors are selling these LIC IPOs, which, there's probably a handful of financial advisors it's brokers who are doing it.
Absolutely.
So it's an important one for financial advisors to get involved in the conversation though and go, no, we're not conflicted anymore.
Yeah.
We don't want to be associated with this, and therefore getting rid of it is the right thing to do.
100%.
In total, and so it's going to be interesting to see what comes of it. There's a bit of back and forth on both sides of the debate in the media at the moment, which has been interesting to read.
I haven't followed.
There's a bit of a slugfest of a couple of commentators on each side of the debate, and it's getting quite personal.
Who's defending it, and what's the argument for the defense?
There's a couple of associations that are kind of vested in it that are defending it. So there's an association of LICs and the Stockbrokers
Association. I'd imagine would be all over it.
So then they've got some people that they've kind of recruited that are sort of well known in the media to sort of help them with their kind of case.
Now, when you say recruited, do you mean paid?
I don't know. Yeah.
I guess we can speculate, but we can neither confirm nor deny.
No. Yes. Don't know.
Okay.
And the arguments for, they're pretty weak.
Okay, I'll scope one argument off the table. We like money. So scope that out. What is the defense?
Like the arguments for is, well, if these, like a lot of the argument is if these things are going to launch, then people need an incentive to
they don't need to launch though. There's so many opportunities already existing.
No, and the counter argument to that is, well, like Magellan just launched a new LIC late in 2019, offering no broker commission, but offering bonus shares for people who participated in the IPO. So it's in the fund manager's interest to raise money in a LIC because then they have this locked in capital, right? Because that's the big advantage of a LIC. Once you've raised that money, you've got a management fee there into perpetuity.
Yes.
But to make it in the investor's interest, Magellan went, well, if you participate in this IPO, we'll give you like one bonus share for every 10 you invest in. I can't remember what it was, but something along those lines. So then it's the investors going, well, I get $11 of value for $10. Yeah, like makes sense.
Yeah.
So then kind of everyone wins.
Yes.
So yeah, and it was easy for Magellan at being a large household name, but if you're a smaller fund manager who doesn't have that kind of reputation, then it's probably harder to raise the sort of money that they did. So yeah, a lot of the arguments for are around that. They're also proposing just putting caps on the commission, like capping it at 1% to 2%. Which I don't know. I guess it's a step in the right direction, but yeah, the arguments aren't.
They're not
that
great.
Strong,
yeah, they're not great.
Yeah.
I don't mind getting. I certainly don't mind people getting paid to help launch a company from private to public. I think that's a difficult journey, and I think there does need to be levels of locked in money to give security to the company that's launching from private to public. But an LIC, I mean, they're not creating any new value or any new asset. They're just consolidating,
they're just buying existing assets.
A chunk of the market. Yeah. And so there's no additional value added to the economy there. So, I can't imagine why I'd love to hear, the person. I might actually go check. So who did you say was giving the defense in the media?
It's Dominic McCormack. He's on Livewire. So most of his stuff's on Livewire.
Right. Interesting.
But I think and I wrote a piece and I did a submission to the consultation the other day, and for me, I think the answer is the active ETF is the answer to this LIC mis-selling issue, because
of course.
I think at the end of the day, and this is why ETFs have just got so popular, is, like investors were never drawn to managed funds because it's so damn hard to buy and sell a managed fund.
Oh, especially if off market.
Yeah, definitely. Like if you don't have access to a platform like an advisor does, and you've got to go and fill in a paper form.
Oh, dude.
You got to give you 100 points of ID.
Yeah.
You've got to do a direct deposit.
Yeah, it's horrible.
And then when you want to redeem your funds, you got to fill in another form. You got to wait a week.
It's so bad.
And so why ETFs got so popular is it's like, I just go into my brokerage account and I just place a trade.
Yeah.
And that's one of the appeals of LICs as well. You can just go in and you can buy a Magellan LIC or a Platinum LIC or whatever. But active ETFs are doing essentially the same thing. And there's some features of LICs that some people say are positive. Some could argue they're a negative. For example, they can trade at a premium or a discount to their underlying net asset value.
Yeah. Now,
if you're an astute investor and you're finding LICs that are trading at a discount and writing them to a premium, you can make money out of that. But if you're a retail investor that just wants to buy a LIC because you like that manager, then you might be buying at a premium, and then you make a loss when it goes to a discount. So there's positives and negatives to that. The other thing is the dividends. LICs, because they're a company, they're paying the tax, and they can pay fully franked dividends, and they can also control their distributions more than a managed fund because they can retain earnings. And that's one of the other arguments for the LICs. But in an active ETF, well, all that's happening is that tax liability is moving from the company to the individual. The individual's probably able to get capital gains tax discounts that the company can't. And then it's on the active ETF manager to then manage their buy and sell decisions in a way that won't have huge skews in distributions. And I think that's one thing that managed funds industry's been poor at over the years, is focusing more on headline performance rather than those buy and sell trades that might realize tax and then create these huge lumpy distributions. So I think an active ETF, if they manage all that, that's the sort of solution.
Oh, definitely.
Yeah. There's a few things that are holding active ETFs back a little bit at the moment. One's ASICs. ASIC put a pause on new active ETFs launching last year for 6 months while they reviewed it. And one of their big concerns is the buy-sell spreads, or the bid-ask spreads of the active ETF. And there's some managers out there who are putting these huge spreads in, because basically an active ETF all ETFs have a market maker that creates the market for them.
Yes.
And an active ETF, a lot of fund managers do that internally to protect their IP.
Yes.
And these fund managers could then put a huge bid-ask spread on, and that's another revenue source for them.
Stop it. Essentially a commission.
Essentially, it's a fee without looking like a fee.
Yeah.
If you've got if it costs you 1% each way on the way in and the way out in a buy-sell spread, then that's a nice little fee for them. So ASIC put a hold on it, and they've reopened it again, but said it's kind of under, we're watching it. But I think they need to probably be more prescriptive about what those bid-ask spreads, put caps on them, or really go to town on the guys who are milking it. And the other thing that's holding it back a bit is the ASX listing fees. It's incredibly expensive to launch a active ETF on the ASX, like reportedly a couple $100,000 a year, just to keep it running. And so if you're a small fund manager, until we get quite a lot in there, it's sort of uncommercial. So it would be nice if the ASX kind of supported the segment a little bit more. I think the ASX has they've pushed their M funds product for a long time.
What did you think of that?
Well,
I thought it was a good solution.
It wasn't a bad idea.
Yeah.
The brokers, most of the retail brokers didn't get on board, which was like
that's because there was no way to get paid, right?
Yeah. But it's it clearly hasn't been a success. I think they've got $1 billion in there now. It's taken
5 or 6 years?
6 years.
Yeah.
And in the meantime, the ETF industry has grown to $60 billion.
Yeah.
So I think it might be time for them to put that to bed and go, we need to better support this active ETF world.
Yeah, no, that makes sense.
Yeah.
I used to use M funds for my SMSF clients. I didn't have many of them, but looking across the universe of options, I was like, well, if you want access to all of this stuff, and this was going back about 5 or 6 years when M funds were brand new, I was like, oh, right, yeah, so ASX are launching these things. You can access all of this without paying platform fees. And in the end, just never took off.
No, and you still have the same issues, some of the same issues with a managed fund where you can't buy and sell in real time. Like I think it's end of day settlements and things like that. The active ETF is probably still a better option.
No, it's a really good point. So active ETF looks to be the solution. There's just a couple of things that ASIC are watching. Frydenberg putting this consultation together with the month of feedback. Some of the stuff was great in terms of what we've spoken about in removing commissions from LICs. Some of the stuff, I don't know if you looked at how it's impacted financial advice at all. There was a couple of other things included in this submission, if that's what you call it, which was limiting financial advice fees being received from my super products. Now, My Super products make up a large portion of the industry at this stage. And when they were launched, you could take, I think it was like 7 different fees out of it. There's an admin fee, there's an investment fee, there was a insurance fee, an advisor fee was one of them. There's a couple other little ones. And now they're saying you're not allowed to, which is not... It's not removing all the options. Like, as far as I can tell, like, I don't know everything about it, but it looks like you can still receive advice fees from non-My Super products. But the problem is going to be advisors have gone through so much recently that tackling this new thing is going to be a big problem. So the whole industry was given, we had FOFA 2013, right? And then between 2013 and 2019, people had to get used to the idea of the new world.
Yeah.
And then 2019 to 2024, I believe, which is you need to have a degree. So there's you got a fair few years to sort of catch up to the new standard as well. This one's like, hey man, we're giving you a month. Yeah. That's a month. A month is too short. So no one's and obviously intermixed with all these other big topics that are going on concurrently, right? Yeah. I'm not sure if you've followed this, because obviously this is very financial advice focused, but it is largely unreasonable to my mind, I think to anyone's mind, because if you would consider the average advisor probably earns 90% of their fees from 90% of their ongoing fees from superannuation of their clients. And the reason for that is, well, it's deductible, like it's tax deductible to the fund, and it doesn't hurt cash flow. And so if you are adding more value, which assumably you are adding more value than the value that you're receiving from the client, then they're ahead. If we remove superannuation being an option to receive fees for advisors, I think we're going to have let's say if it was just this, so there was no other new requirements, the financial advice had just been sitting around chilling out for the last 10 years, and this was the only thing.
Yeah.
It could get done if you gave it, again, the sort of the 5 to 6 year mark.
Is it really? They've only given it a month.
Well, that's right. So this consultation.
Oh, the consultation on the leaks though is that's a separate consultation.
Right. So
that the one you're talking about is the Royal Commission proposals, right?
Yes, but there's still a month of consultation.
Oh, okay.
Yeah. And so people will have a month to decide if this is a thing that's going to go forward or not. Now, obviously, I don't imagine it's going to be enacted day one.
Yeah.
But while everything else is going on concurrently, my God, like advisors have got so many balls just like getting
been
pegged
like
at
for
them.
10 years now, right?
I know, but I swear to God, it's ramping up. Like it's impossible. I've spoken with a handful of advisors. I've done media interviews. I've spoken to the head of associations, like in the last week, and this, I can tell you, is going to have a bigger effect on advice than all of the other stuff combined, because the other stuff's annoying, but it was given enough time, and it wasn't 90 to 95% of the revenue.
Yeah.
Like this is a huge thing.
Yeah, it's a hard one, the fees in super, because I get the point of what they're trying to achieve here.
Same, me too.
But, like most people don't have the cash flow in their pocket to be paying the advice fees that are high because there's so much compliance.
Totally. Yeah.
So, you want more people to get good advice, but you clearly don't want them to get ripped off.
Yeah.
Yeah, I don't know what the happy medium is there.
Yeah, I would suggest not putting this on the table until the education standards are finished. That would be. I'm like, okay, can we just hold off till 2024, and then talk about it then? Yeah. That would be that. I would like to see that happen, because the we had, like in the industry, it was reported that 16 advisors killed themselves last year. Big deal.
Absolutely.
And this is going to, I don't want to say it, but I feel like it might replicate it. Which at its worst, right? And that's now terminal.
Unfortunately, the government wants to be seen to be taking action, right, out of the Royal Commission.
Yeah, but they already have.
Yeah,
they literally already have.
Yeah.
Like, you've achieved, there's huge changes.
Yeah.
Need to hold off. Like, for legitimately the lives of some people that because, and I keep saying this, they're stretching to grow and they're stretching to breaking point.
Yeah.
And this, I fear, will be the latter, but hopefully I'm wrong. So in amongst your interesting career, sort of, starting in corporate land, going through advice land, paraplanning, a little bit of advice, kicking off an ETF company, you've got some UX skills up your sleeve. Something that's really interesting in your career is you are working on a superannuation fund.
Yeah.
Now, this is a world that I'm really passionate about, obviously because I was an advisor, had my own company, and then got pretty close to launching a superannuation fund myself. And the reason why I did it is because the importance of that chunk of money is of utmost importance, right? Like, even though you can't spend it for a long time, when you need it, it's excessively important. But because of the time to expenditure, no one cares about it. And so the only solution that you can achieve to get people to care about it is emotionally engaging them in their investments rather than just telling them that there's lost super.
Yeah.
And so one of the many benefits that advisors provide is they give a human face to their superannuation. So if you're my advisor, I go, Steve, how's it going, mate? And you go, good. This is what's happening in your super, and explain it to me and show me and give me modeling.
Yeah.
Otherwise, all that's happening is I get a letter in the mail once a year with a colorful pie graph. I don't know anything about it. I disdain it. I say at its worst, it's an extra tax, you know. At best, I don't care. Yeah. Right. So that's the current environment. The apathy and disdain is far higher or exceptionally above the importance of it.
Absolutely, yeah.
And so I'm really passionate about it. I wasn't able to succeed because superannuation is very difficult. And you, for better or for worse, have ended up on the same path. And I'm looking at your drink bottle right here, and it says Tomorrow. So Tomorrow Super, you're a part of this team. Talk to us about what it is that you want to help people achieve.
Yeah, so it's a big question.
It is, but it's the most important one.
One of our key sort of mottos is giving people more transparency, choice, and control. Mm-hmm. And so we think in the super space, that's something that probably a lot of funds haven't provided. Whether it's the transparency of what you're invested in, the choice of what you can invest in, or the control of how you're going to invest it. And clearly, financial advisors do a lot of that work for their clients, and they use platforms that support that. Mm. And so we've gone into Tomorrow with a sort of financial planning mindset where, we want transparency. So we're looking at using managed accounts so that our clients can see what they're invested in. Building portfolios that are risk profile based. So, a lot of the new super funds kind of give you two options, if you're lucky. Yeah. Whereas, we've come out of the world of financial planning and, the different risk tolerances and everything. And so, risk profiles, and then also the tools to allow people to work out their risk tolerance and sort of track it over time. And then, there's just a whole bunch of things that, insurance, it's obviously a really important part, but probably neglected by a lot of the direct-to-consumer offers. Either they don't offer insurance, or it's, you know, you got 50 grand in a default insurance option and that's it. So allowing people to, you know, work out how much insurance they need and offer that within the solution. So yeah, that's kind of the path we're on.
It's been a long journey, right?
Yeah, it has been.
'Cause, I mean, from the time that I was trying to set up my super fund, you guys have been around.
Yeah.
So
I'm
I'm guessing like 3 or 4 years.
Yeah, I've only been part of the company for a few months, but Wes, our CEO, he's been going for a while.
Yeah.
With a few pivots along the way. We're getting much closer to launching now. And like one of our things is also, you know, we've come out of the world of financial advice. We understand the value that financial advisors give, and we're not looking at taking that away. And so we're going to have a direct offer, have a great user experience.
Oh yeah.
And you know, there's like with most super funds, you've still got paper forms to fill out to do simple stuff, and it's like,
yeah, man,
like it's 2020.
Yeah, it's painful. My wife, you know, because we're pregnant with our first child, and she sort of said, okay, well, I want to look at my insurances, I want to look at my super, and I want to look at it all. I said, okay, cool. Well, you know, like I'm pretty experienced in this sort of stuff. So we had a look at all of our super funds. We found the one with the most insurance, but it still took us about 2 months to get everything to the point where it was finished.
Yeah.
And 2 months. Yeah. And I know what I'm doing.
Yeah. That's painful.
And I mean, we've got SuperStream too, that's existed for many years. Like the government actually has built the back office for the super funds to be far more efficient, but there's too much money in not educating the client. There's too much money attached to making people seem like it's difficult, that the industry has been built on how do we make this more difficult.
Yeah, absolutely.
And so it's a challenge. I know, for example, if you look at, I guess, the big 3 new super funds that came out over the last few years, you had Future, which no one really spoke too much about, but they had a really good launch strategy. They identified their target market really well, and they just went after them.
Yeah.
Which was essentially left politics.
Yeah.
Like if you believe in left politics, you believe in this super fund. And then you had Spaceship Super, which was far more mass media. I've never met the girl that did the growth hack for that launch. To my mind, it's the greatest growth hack launch in Australian history. To get people to care about super was phenomenal. Now, of course, if you sort of tracked the success of Spaceship over the last few years, they did remarkably well upon launch and have kind of not quite lived up to the expectations. No. And that's the difference between having a growth hack and having a consistent message that backs up that growth hack, right? Not to fault what they did. To be very clear, they nailed it, right? They did extremely well. And then you've got Grow Super, who they gave multiple options. I really liked the premise of this product. It was like, do you believe in ethical? Do you believe in green? Do you believe in tech? Do you believe in, you know, what is the thing that you want to be invested in? Here's your tilt. And then how much between 0 and 15% do you like really believe in it? Yeah. Man, like the premise for that product was really cool, done by a really young team, you know, killer team. Again, did quite well on launch, and then such is life, superannuation being what it is, people don't care too much about it. Acquisition cost is, you know, around that $400 mark. They're fighting lethargicness, is that a word? Anyway, fighting apathy. Yeah. And in the end have become sort of a back office to IOOF, and they're succeeding quite well there now, as far as I can tell. And the big news, the big news is Sargon.
Yeah.
that blows those three
That's interesting.
out of the water. And so out of those three super funds, Future Super's done relatively well. Spaceship and Grow have struggled despite how well I thought they did on launch and their product, the premise of their product. And then you've got Sargon, which raised, $100 million, I think it was. Huge. Yeah. Just huge amounts of money. I know Peter Thiel was involved there. I think he got out quite quickly though. And they've just gone into, now I've got to be clear with my words here, administration. Yeah. Administration, not liquidation. Yeah. Which means so essentially they have volunteered, right?
Yeah. And so they have Diversa as a trustee in their stable.
And trustee partners. So they own two trustees.
Who are the trustee for most of their super funds.
Yeah. Well, between trustee partners and OneView, that's got 90% of the new super fund market for sure. Now, it's Diversa was sold by OneView. I wonder if OneView get the money. I guess out of all of the companies, they're probably the most concerned. But what's interesting to me, and my point around all this is, financial services is really difficult to launch and succeed in. So with Tomorrow coming on board, do you guys expect to be able to service consumers and advisors? Like, will you ultimately be a new challenger to what I mentioned before was Net Wealth and Hub24 are doing really well? Do you expect to try to take that on, or do you expect to try and take, on where sort of Spaceship and...
Yeah, it's a good question, and still working through that.
Totally.
But I think like because we have this financial advice background and we believe in advice.
Yes.
But we also believe in great user experience and great client outcomes. We think we can, we're going for the direct market.
Yep.
But we also think we can build a product that we can work with advisors on. Now, will we ever try to be as fully featured as Hub and Net Wealth with 5,000 managed funds and all of that sort of and all the other capability that they have? No, we're not looking at sort of directly competing, but for the advisor who has a client who, they believe in managed portfolios and they believe in our managed portfolios and they're looking for a low cost solution with a great user experience, like we might be the option that they can use for them.
Cool.
Or, these days there's more and more clients that advisors are switching off their ongoing advice because they're saying it's not commercial to service you anymore. But then what do you do with portfolio management for those clients? This might be a solution for those sort of clients where it's like, these guys will help you out, and you can tap into advice when you need it with me.
Yeah. Okay.
So I think that's where I think there's an opportunity.
Yep.
And hopefully we can get there.
Man, I'll take my hat off to you if you can get there. Look, it's a really hard road. Yeah. I pursued it for 18 months full time. And the amount of respect I have, actually, there's another one, Grant Britz. He did Super Estate, which he's like consistently growing, and he knows exactly who his market is. He's going after Queenslanders who love property. Like he's like, these are my people, and this is the asset class that they like, and he understands his market really well. And he's actually sort of the dark horse. He's just plugging away. He was one of the last ones out of that sort of cohort of new super funds that came out. And he's building it, and I catch up with him every now and again. He's a really good guy. He's a former Olympian, and he doesn't like to sort of talk about it, but he's won medals in the Olympics and stuff like that. Yeah, he's a good guy, and I wish him all the luck, as I do you, mate. So I just have infinite respect to anyone that's able to do it, because
it's a tough space.
It is a really, 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 really tough space.
There's a lot working against you, like the compliance and that sort of thing alone.
The whole industry loves dragging things into mud so that they don't move, and then enjoys watching the young entrepreneur squirm and goes, didn't expect this, did you, buddy?
Yeah, that's true. But and nothing's easy, right? Yeah.
Nothing's easy. Yeah. That's a really good point, man.
Yeah.
Look, thank you so much for coming on, sharing us your story, what you've been up to, what you're getting done these days. If there's advisors out there that are interested in reaching out, like hit us. What's your websites? What's your LinkedIn?
Yeah. So etfwatch.com.au. Sign up to the mailing list. We send a monthly email with an update on what's happening in the market. Also, always looking for guest contributors. If you're an advisor who has an opinion on some of the things that we talked about, or just the market in general, or portfolio management, love to have someone else writing my content. Clearly would put links back to your website and all those sorts of things.
That's pretty good.
Get in contact if you're interested. And then, if you're interested in following Tomorrow Super, tomorrowsuper.com.au, you can sign up to our mailing list there, and we'll be in contact when we kind of get launched.
Very good. And people can find you on the XY platform as well.
I'm on the XY platform. Yeah. You can also find me on LinkedIn.
Yes.
Yep.
Very good.
Yeah.
Awesome, man. Well, thank you so much for coming on.
Thank you.